So far we've seen that a little bit of add, subtract, multiply, and divide has given us insight on short-term liquidity. We've also examined the liquidity and capital structure of the business using leverage ratios. Now we're going to look at profitability ratios. Here, industry standards are very important to the analysis. As we mentioned, we are using standards for clothing wholesalers. These standards vary greatly depending on the industry. Even without having any standards, the forthcoming analyses are revealing. It should be pointed out, calculating profitability ratios does not, in and of itself, improve operations. However, it indicates where opportunities exist to make improvements. We say, any process that is not managed is out of control. Managing a business means trying to increase revenue, which unattended goes down. All expenses have a natural tendency to go up. With the next 6 ratios, we have our management scorecard. In our view, it is positively thrilling to consider that just a few hours ago, we started this program. And now we're going to perform a truly sophisticated analysis on this business. And we're doing it with just add, subtract, multiply, and divide. This type of analysis is used by Wall Street analysts, bankers, investment bankers, business consultants, and entrepreneurs. The ratios are gross margin divided by sales, operating profit divided by sales, net income divided by sales, net income divided by total assets, net income divided by equity, and finally, net income divided by total assets minus current liabilities. Wow. Let's get busy. Here is ABC Company's financial statements again, beginning with the statement of financial position. To summarize, current assets, $350,000, fixed assets, $300,000, current liabilities, $150,000, long-term debt, $175,000, total liabilities, $325,000, equity, contributed capital of $100,000, retained earnings, $175,000, total equity, $275,000. Liabilities and equity total, $650,000. Also, note the share price is $45. On this slide, we revisit the statement of earnings. Sales, $940,000. Cost of sales, $620,000. Gross margin, $320,000. Total operating expense, $264,000. Earnings before interest and taxes, EBIT, $56,000. Net income, $35,000. Our first profitability ratio is gross margin divided by sales. Gross margin to sales is a critical ratio. It shows the profit available after deducting the cost of sales. It's all the profit left to pay operating expenses and still produce a net profit. If gross margin declines, even managing all other expenses, earnings will still suffer. Gross margin, $320,000. Sales, $940,000. Gross margin percentage, 34%. The standard for clothing wholesalers in the U.S. is 40%. That means our gross margin is 6% below standard. The budgeted gross margin on $940,000 in sales is $376,000. That's $940,000 times 40%. That means we are $56,000 below budget, right at the top line. Now, calculating the ratio does not solve the problem, but it alerts us to a problem. What causes eroding gross margin? Input prices rising, but we don't raise prices. Competition driving prices down. Overstocked or obsolete inventory, seasonal markdowns, theft, a new product line that's not performing well. Later in this program, we'll introduce a bonus chapter, 4 case studies on how to improve business profitability. This next ratio is the operating profit ratio. We divide operating profit, EBIT, by sales. EBIT, earnings before interest and taxes, is $56,000. Sales, $940,000. The ratio is 6%. The standard is 10%. Once again, the below standard gross margin makes it difficult to recover this ratio. Here we have a portion of the income statement showing earnings before interest and taxes of $56,000. Here we see a top portion of the income statement showing sales again of $940,000 and cost of sales $620,000. This ratio is net income before tax divided by sales. Consider this. The 500 largest companies in the U.S., the S&P 500, earned an average of 12% in 2023. But that number is distorted by just a few tech giants: Apple, Google, Microsoft, Facebook, Amazon, and Berkshire Hathaway. Most S&P companies make about 7% on sales, all the capital and effort resulting in profits of about 7%. On the following slide, we will show a portion of the income statement showing income before tax of $45,000. $45,000 divided by sales of $900. $40,000 is 4.8% versus a standard of 7.5%. Once again, ratios don't solve problems. They simply identify them. In subsequent ratios on efficiency, we will be able to pinpoint where waste and loss are coming from. The problem with many of the profitability ratios is that the decline in gross margin is so precipitous that we cannot make up its damage. In a business, we use assets to generate sales. Assets are financed by debt, which has an interest cost, and by capital, where investors expect a return. In our first ratio, we compare sales divided by total assets. Our $940,000 in sales divided by total assets of $650,000 yields a ratio of 1.45 to 1. The standard is 2.5 to 1. This standard is for a clothing wholesaler. Different businesses will have different standards, but even without a standard to compare to, we have an actual ratio of 1.45 to 1. The higher this ratio, the better. Our actual ratio indicates that assets barely turn 1.5 times a year. Since assets cost money, we as managers want to manage assets as efficiently as possible. Total assets of $650,000, as shown on the balance sheet, used in our calculation of sales divided by total assets. Here we have net income to stockholders' equity, also known as return on equity. If profits belong to shareholders, then what was their return? Net income is $35,000. Stockholders' equity is $275,000 for a ratio of 12.7%. We earn about 2% on Treasury bills, about 4% on high-grade bonds. But an investment in stock has a higher risk and a higher expectation of return, about 10%. Here, our return on equity is 12.7%, better than the standard. FYI, the standard is for an investment in common stock of any kind, not just clothing retailers.